Here we go again, and we're going to start with dividends payable. Dividends are the amounts that have been declared by the corporation to be paid to the stockholders. It is their share of earnings. Now, stockholder boards of directors do not have to declare a dividend. Uh, this only happens upon the judgment of the board of directors. However, the date that they declare the dividend and the amount is the date the obligation begins. Now, typically, your dividends, once we have a declaration date, will be paid within 3 months. As you'll recall, there are several dates that are tied to dividends. There's your declaration date. That's the date the board of directors says they're going to pay out X amount of money. You have your date of record. That is the date where owners of record on that specific date are the ones who will receive the dividend. And then, of course, there is the actual payment date. These are all three very specific dates that are related to dividends. However, typically this all occurs within a 3 month period of time. However, it can take through up to 12 months. However, that is not the case. It is almost always paid in less, and rarely do you ever cross that 12-month. So that is why they are a current liability. Now, some of you will recall we've actually talked about different types of stocks before. We've also talked about those in prior classes. You know, there's common stock, there's preferred stock, and then there's different rights and preferences that can be attached to different types of preferred stock. If you recall, there is some preferred stock that has the cumulative preferred stock. This means that the dividends that are attached to it, they will receive at some point in time, which means that if there has not been a dividend declared for several years, there are what is called preferred dividends in arrears. Coming into our class next week, I want you to tell me and think about why these are not a liability, as you can see here. We don't recognize them as a liability. Why is that the case? I want you to tie back to the definition of a liability. And then I want you to, so I will ask somebody in class to share with me how we do treat these dividends in arrears when it comes to our financial statements. Now, dividends payable in the form of additional shares of stock are not reported are reported only in our stockholders' equity. This is because they are only a movement. So when we have stock dividends that are paying out, we're just kind of redistributing the elements in the stockholders' equity section. We aren't actually dealing with any type of cash or goods that will need to be paid out. However, if there is any cash or goods that are attached to it, then they become a cash or a goods dividends payable. Who else, as a corporation, might we owe money to for some reason? Now, a dividends payable is we've declared that there's a dividend and we are going to pay this to our stockholders. One of the other places this might actually happen, where we might have to pay somebody something back, is in our customer advances and deposits. So these are returnable cash deposits that have been received from customers or employees. This can happen in a variety of reasons. Often it's tied to a contract, um, either for service or to guarantee payment of expected future obligations. So let's think for a minute. One thing that most of you can kind of understand and may have dealt with upon at one point in time or another is a security deposit for an apartment. So your security deposit is a guarantee that you will return the real property, the apartment, in the condition in which you received it. If not, then your security deposit will be reduced by the amount necessitated to bring that particular property back up to the status quo. So it is a guarantee that you will perform accordingly. And it serves to cover any payments of an obligation that you may have as the result of failing to maintain the property. Now, your security deposits, cash deposits, or advances, either from customers or employees, can either be current or long term liabilities. This is going to depend on the nature of the deposit. If you have a 3-year lease, your security deposit is going to be long term because it's not going to be expected to cover any type of obligation for 3 years. However, if you put down a security deposit to rent a room because you're going to have a party there, that is most definitely, as long as you're going to have that party in the next 12 months, going to be a current liability. So, as you can see, a lot of these different types of liabilities, while typically current, can also be classified as long term depending upon what they are tied to and the timing of that, and where the termination of relationship or obligation will occur. Another one of the topics that we'll talk about in this specific uh, lecture is unearned revenues. I know that I have talked to you about them. Anybody that has had me in any other class has probably heard me expound on them. And part of the reason I do that is because a lot of people have a difficult time adjusting to unearned revenues and then figuring out how to bring them in. So, one of the things I will do for unearned revenues is I will be bringing into class a demonstration of how we handle those for such a thing like a membership, let's say a pool or a club membership that you pay all for in January, but you get to use it over 12 months, and how we handle that. So just be aware that I will be bringing that with us to class. If we do run out of time in class, I will do a separate lecture just showing how I do that as well. So, unearned revenues are when a company has received payment from a customer, but they have yet to provide the good or service. So, for example, we get these all the time nowadays. Most of us have some type of a subscription to some type of a software, whether it's we're paying for Microsoft 365 or we're paying for Adobe Document Center, whatever the case may be. Now, we pay sometimes completely up front. We pay a full year. So for when I purchased Lightroom, I paid for 1 year's worth of Lightroom. Adobe now has to allow me to use that program for 12 months. Therefore, they have that obligation to provide me a service every month. They've not earned all of that payment on the day I give it to them. Some of the other areas you'll find this is hotels. Anybody that stays in an efficiency hotel, for example, I have some friends in FEMA, so they're living in like a residence inn or they live at hotels because they're being moved around frequently and they pay for a week, 2 weeks, even a month when they arrive, but the hotel hasn't earned that yet. They will only earn it daily as the individual is there each day. Gift card revenue is a huge unearned revenue for retailers, and a lot of them have a large volume of it, especially this time of year following the holiday season. A lot of us don't know what to do, right? You pulled Aunt Sally from the gift exchange, and you don't really know enough about Aunt Sally to buy her something, or she's one of those people that you just couldn't make happy with a gift, no matter how hard you tried. So it's easier and safer for everybody involved if you go to her favorite store. Maybe it's Bed Bath and Beyond, Bath and Body Works. Maybe Aunt Sally is very handy and her favorite store is Home Depot. And you just buy a $25, $50 gift card and give it to Aunt Sally and you make her day. Because now she can go pick out exactly what it is she needs and or wants. Now that gift card revenue is yet to be earned by the retailer because they've yet to actually exchange a product for the money. So until Aunt Sally goes in and actually purchases her power drill from Home Depot, it is not earned. It is considered unearned revenue. Now, the point at which they actually recognize the revenue is the point in which they have fulfilled the obligation. Because remember, according to the revenue recognition principle, we recognize revenue at the point in which we fulfill the obligation. So, for looking at all of these, if it's the airline, it is when the actual flight occurs. For a magazine publisher, maybe that is every month as the magazine is published and received by the customer. For the hotel, that is daily or more nightly as the individual stays. Warranty revenue, we actually really dig a little bit more into warranty and assurance later in this class, but let's just say that that is when somebody brings something in and has warranty work done on that day. And then for retailers, this is when the gift card is fulfilled and a good or service is exchanged for the gift card. So, to start out, we'll talk about Allstate University. They have 10,000 season football tickets at $50 each for its 5 game home schedule. They record the sale of the tickets at the point in which they actually sold them. So, this is going to cover 5 games. 10,000 tickets, $50 each. That's $500,000 in cash that was received. But they have yet to play a single game. So it is all unearned revenue at this time. Now, as each home game is completed, so on the day in which the home game is played, they will make this entry. They will have unearned sales revenue of $100,000 that will be decreased and moved over to sales revenue to recognize the revenue in the period in which the obligation has been fulfilled. That is 500,000 divided by 5 games or $100,000 per game. Now you have this in your book. It talks about Microsoft's liabilities and good or bad, and it actually very much drills in on unearned revenue because unearned revenue is a liability. And the word liability tends to have a negative connotation. But I want you to really read this and think about how it is not just the existence of a liability, it is actually what the liabilities are comprised of that says whether it is in a good or a bad situation. Liability does not necessarily mean bad. In cases such as this, it's actually a key indicator into positive growth and revenue streams. Please take at least 5 or 10 minutes to actually really dig into this, read it, and think about it um, before we move on to the next lecture. Now, the next lecture, we'll start talking about sales tax payable, income tax payable. We'll be popping up with some payroll information. I know many of you covered payroll to some degree in 122. And then we're going to also have the compensated absences and bonus agreements in that as well, because this is all kind of very much related to uh, either sales tax, income tax, or an income tax rolls over to our federal withholdings, which deals with payroll. The last regular current liability that we'll actually talk about is current maturities of long term debt. That will be one very short lecture in and of itself. And then I'll be going on to talk about contingencies. What are contingencies and what do we do and how do we deal with them? Whether they are gain contingencies or loss contingencies. Um, and we'll also be talking about the classification issues of short term debt that we expect to be refinanced. And what does that mean for our financial statements? If you have any questions, of course, start jotting them down so that way we can bring those into the classroom. Send those to me via email so I can bring additional resources with us and or post those to Canvas.